most of you know, today is episode 5 of the FP&A or Who Wants to Be an FP&A Ninja quiz, which we have been doing over the last several weeks now. And today's topic is on capital budgeting. And before we get into the quiz, I wanted to give a quick shout out to our co-partners and co-sponsors, including Drivetrain, Pivot Excel, GA Management Consultants, and Blocks. So with that, let's get started. And yes, how can I forget? So a big thank you for everybody who supported my book launch last week. So because of your support and your a lot of people who even bought the book, and because of that, it became Amazon #1 bestseller for 2 days consecutively on Saturday and Sunday last week, and it is still the #1 Amazon bestseller in one of the categories. So thank you so much for supporting the book launch. And with that, we'll quickly run through the objective of this quiz and then get into the warm-up round if there are a lot of people who are new. If not, we'll directly go into the main quiz. So as you know, this is for increasing awareness about FP&A and FP&A roles so that we get more talent in FP&A. Understanding FP&A concepts is another objective, so that we share FP&A concepts through a fun and an engaging format, encouraging continuous learning and also networking. So at some point of time, we might also do in-person events, not planned as of now, but the idea is to meet in person at least once in a year or maybe even twice in a year. So we plan those events as and when we get an opportunity. So thank you so much for joining. Some of you may be here for the first time, so I'll quickly run you through the rules of the quiz as well. So there will be a link that you will see. So you will see a QR code and a link which you can use to join the quiz. Okay. Once you join the quiz, you have to enter your name. So make sure you enter your full name. If you have a longer name, like some of us do, use your first name as the full name, and then you can use the initials for your last name. In case you drop out in between the quiz, in that case you will be able to rejoin using the same pin, and the pin is at all times displayed at the bottom of the screen. I'll show you where it is displayed when we start the quiz, but if you drop out and if you want to rejoin, you can use that same pin and join again. Be on camera if you can, and stay on mute, avoid background noise while we are playing, and we'll take questions at the end. Let me know how many of us are here for the first time, never played this before. So type me in the chat box. So, okay. I see one person. If we see like 4 or 5 new names, we'll do the trial round, or else we'll directly skip to the main quiz. Okay, so 2 new names. Okay, anyway, let's do the trial round. I see few more people are coming up and saying they're first time players. So we'll do the trial round. So what I'll do is I'll launch a trial quiz, and I request you to keep your hands down for now, and I'll come back to you for questions once the quiz is over. So let me just launch. So I'll have to stop sharing for that, and we'll run a test quiz, and that way you'll get used to the format. So what I'll do is I'll pull up the last week's quiz and see if you can join that. Now, when I launch the quiz, you will see the screen and the quiz loading up. Once you see the screen load up, you will see an option to join. So it's still not yet there. It'll come up. So once I click on start here, you will see a link here, which is www.kahoot.id. So either you can go to this link. I would recommend you use your mobile phones to play this, and you use your computer or laptop to look at the questions. So that will be the best way to play. So use your computer screen to read the questions, and then use your mobile as a voting meter, or you can use that to just vote. Now you can join in 2 ways. By 2 ways, one is you can go to this website and then enter your PIN, or you can scan this QR code. This QR code will again take you to the same website. Okay, once we do the main quiz, this is a trial round. But when we do the main quiz, we will give about 60 seconds for you to join. And for people who don't join, I mean, in those 60 seconds, they will probably be behind in the quiz. Okay, so I see 15 people have joined the trial round. We'll give it another 20 seconds and then start the main round. And then start the trial round. Okay, let me just check if anyone is trying to join the quiz but not able to join. Okay, so you have to use the link here. Mo, you have to use this link. I'll put that link in the chat box. So you have to use your mobile phone and go on this link. Once you go on this link, you can then enter the pin and then join. Okay. All right, so let's start the trial round. And for people who are new, especially, pay attention to this. And one thing I wanted to share is the faster you answer, and most of you know this, but again, I'll repeat, faster you answer the question, the more points you get. So if you spot the right answer, just go and hit or touch the right answer. Okay, so this is from last week, and we'll see what questions we had, or we'll do one of those questions. Okay, I'll read out the question in the main quiz as well. So I'll read out what does a debt to equity ratio of 2:5 indicate, and you have to select the right options on the screen. What you have to do is you have to read the options from the screen and then select the right color or the right shape. You notice the color or the shapes here. You will see that color or the shape as options on your mobile phone. Okay, so hopefully you got an idea of how to play, and we'll now move to the main quiz. So let me just stop this. Okay, so are we ready for the main quiz? I want to see some yeses or I'm ready, something like that in the chat box so that we launch the. So the new game pin will appear now. So we will, I mean, once I launch the quiz, you will see the new game pin. So keep an eye out for that. It'll appear on the screen just like the one we did for the trial round. Okay, so let me just launch the new or the, I mean, today's quiz on capital budgeting. So I'm doing that now. I'm just pressing allow Zoom to connect to Kahoot, and Zoom is now connecting to Kahoot. And in few seconds, you should see the screen coming up. I am clicking on start quiz. Uh, once you see the game pin, it is 9:11 right now, 9:12 right now. So we will wait for maybe one full minute. So we'll just to be safe, we'll wait and we'll start the quiz at 9:14. So you have one more minute, one full minute, and some more time to join the quiz. Okay, I see a lot of people are joining. Already we have 14 people on board. We have 34 people or 35 people here, so I'm expecting few more people to join. Okay, 28, maybe 5 more people. Okay, I'll not count myself, so 4 more people. Okay, 35 on the call and 34 excluding me. So 29. So I'm hoping other 3 people are also joining. So now it is 28, 29. Okay, once this crosses 30, we'll start. Okay, so we are about to start. As soon as the clock hits 9:14, we'll start. Okay, one more entry, and with that, I am now starting the quiz. Okay, so this is episode 5 on capital budgeting, and let's see who wins today. Your first question will appear on the screen. What is NPV? What is net present value of a project? Okay, I see most of you or majority of you got this right. So it is the present value of future cash flows minus the initial investment. Okay. We'll see more on NPV in few minutes, but let's see who's leading the leaderboard. Okay, so we have Sagar, followed by Sheetal, Jigyasa, Yogesh, and Yon. So I hope I pronounced that right. So we'll come back to NPV and then we move to the next question. So NPV, as most of you know, is most common metric in capital budgeting, which is used to evaluate any investment's profitability by comparing two things. It compares the present value of all expected future cash flows against the initial cost of investment. So that's what the NPV does. Most cases you would evaluate saying that if the NPV is greater than zero or positive, you will go ahead with the project. It'll be accepted in your capital budgeting terms. And if the NPV is negative, it may not be a good project. Is what NPV helps you to calculate. Okay, with that, we'll go to the next question, which is on which method evaluates profitability of investment by comparing present values of cash inflows to its initial investment. Okay, remember you have to answer the most correct answer. There might be a situation where two answers might feel right, but you have to then pick the most right answer, or in our case, maybe the best answer. Okay, so in this case, comparing is what the ratio does. So in this case, the right answer is profitability index, and we'll come to that in a few seconds. We'll talk more about that in a few seconds. But let's take a look at the leaderboard. So there is some changes. I see a couple of new people in the top 5, and still early days. So we come back to the leaderboard. Before that, let's take a look at the profitability index. So profitability index is, or PI, is calculated by dividing the present values of future cash flows by the initial investment. So it's a ratio of your present value of future cash flows divided by the initial cost of investment. So that's how you are comparing the two using that ratio. A profitability index greater than 1 usually indicates it's a good investment, and it suggests that for every dollar invested, there is a return greater than $1. So that is what the profitability index does. Okay, we'll take questions at the end, so we will clarify any doubts, any questions that you have on these questions at the end in the last 10-15 minutes. For now, let's keep moving on. We'll go to the next question and let's see what that question is. What is the purpose of sensitivity analysis in capital budgeting? And you see 4 options on your screen. Okay, good to see most of you got this right. So it is to evaluate how changes in the key assumptions affect the outcome of the project. So that is the right answer, and we'll see more on this in a few seconds. Let's take a look at the leaderboard. So leaderboard says that Yogesh has entered the top 5, and 3 players have reached a winning streak, which is answering back to back right answers. So congratulations, and we'll see what sensitivity analysis is. So it is a technique used to predict how different variables or how changes in different variables will impact the outcome of the project. So Usually you change one factor at a time while doing sensitivity analysis, keeping others constant. And that's how you can see how sensitive your result or your model is to the changes by changing that one factor. So how your answer or how your output changes by changing that one factor. So that is what sensitivity analysis does. Let's go to the next question now. So what does discounted payback period account for that the regular payback period does not? Okay, hopefully this is straightforward. You have 10 more seconds to answer this. Okay, so the right answer is that the discounted payback period accounts for the time value of money, which the normal or the regular payback period doesn't. What is payback period? We'll come to it in few seconds, but let's see the leaderboard first. Okay, so we have Sagar, Bharat, Sampada in the top three, followed by Ayushi and Yogesh. And we'll see how this looks like in the next question. So let's take a look at the payback period and discounted payback period first. So what is payback period? Payback period is usually the time. So it's not a dollar calculation, it's a time calculation. It's the time necessary for any investment to be fully recovered. Okay. Usually there are two types of payback period you calculate. You can calculate either a simple payback period or a discounted payback period. Your simple payback period does not take into account your time value of money, while your discounted payback period considers time value of money. That was the question that was asked. Okay. Usually, longer the payback period, bigger the risk for the project. Shorter the payback period, the better, or probably better it is in terms of evaluating that project. Okay, so that was on the discounted payback period and simple payback period. Let me go to the next question. Okay, what is the main advantage of using NPV over payback period? So what is that advantage or what is the benefit of using NPV over payback period? Okay, and the right answer is NPV considers the time value of money and provides a measure of profitability. The payback period is the time or the break-even point or the time calculation. It does not consider uh, the payback period. The simple payback period does not consider the time value of money as well. So that is the main advantage of using NPV over payback period. Okay, let's go to the next. I don't see a lot of changes, so the top five are fairly stable now. Let's see if we have new people in joining in the next question. Okay, so we have question number, I don't know what question number this is, but we are almost halfway through it. So what does IRR represent? What is internal rate of return? Okay, so the IRR represents that the discount rate would result in the NPV being zero. So that is what the right answer is, and we'll take a look at more on that after we take a look at the leaderboard. Okay, so slight changes. So we have two new people, Vivek and Rishi in the top five, and Bharat has climbed up to the first position. So some changes happening after a couple of questions there, and let's see what is IRR. So IRR, as we saw, it is the discount rate or the interest rate that makes the NPV of all the cash flows from an investment equal to zero. So that's what the question was. It is the rate of return at which the investment breaks even, meaning that the present value of its expected cash inflows will equal to the present value of its expected cash outflows. So that is what IRR is in simple terms. Higher the IRR, more attractive the investment. or more attractive the opportunity is. Let's go to the next question, and we are coming very close to the end. So we maybe like last few questions. So, what is the modified internal rate of return or MIRR account for that the traditional IRR does not? Okay, and most of you got this right. So the MIRR or the modified internal rate of return suggests that any intermediate cash flow or any cash flows that come in between the project, they are reinvested at the project's cost of capital. So that is what the MIRR does over the traditional IRR. So that's the benefit of using MIRR over the traditional IRR. Okay, so we have some changes, and I see some people new as well. Nitin has joined in the top five. So let's see what happens in the next question. Before that, MIRR, as we saw, is unlike the regular IRR, it takes into account that the reinvestment of the cash flows will be at the same rate at the project rate, which provides a more accurate reflection of the investment potential. That is what the MIRR does. Let's go to the next question, and this is a calculation. So make sure you freshen up your mind or get a calculator if you can. A new machine worth $120,000 is expected to generate cash inflows for 30,000 every year for the next 5 years. What is the payback period? Hopefully, this is simple. Not to You don't need a calculator for this, right? So 1,20,000 or 120,000 is the initial investment. You're recovering 30,000 every year, so you will recover the investment in 4 years. 30,000 into 4 will be 120,000. So that is the payback period. Okay, now we go to the next question. Before that, let's see the leaderboard. So we have, I noticed one, I mean, some changes in the top three, and also Vaishali entering in the top five. So congratulations. And we are getting closer. I think only two or three questions are remaining. So keep an eye on your mobile phone and get to the right answer. Investment of $80,000. So initial investment $80,000. Cash inflows is 20,000 for 5 years every year. Discount rate is 10%. You have to calculate the payback and the discounted payback period. Okay, so most of you got this wrong, which is strange. Anyways, we'll take a look why that the answer is answer one. So payback period is simple, right? So and the option yellow and green are ruled out because 20,000 into 4 is 80,000. So your simple payback period is 4 years. I hope everybody understand that at least. So option C and D are out of question because the payback period is 4 years, which is clearly visible from the question. Now you have to think about the discounted payback period. In this case, it says that the discounting payback period is 5, and we'll see why. And you don't need a calculator for this, so we'll come to it in a few seconds once we take a look at the slides. Once we take a look at the leaderboard, so Sagar is in first position, followed by Yogesh, Rishi. I see Sagar has a considerable amount of lead. So good luck to others. And top five are looking good. We'll take a look at the slide and we go to the next question, which is most likely the last question for today. So your discounted payback period is always going to be longer than your simple payback period. So you didn't have to calculate it. Uh, One of those options in the other option, which is the wrong option, the discounted payback period was less than the simple payback period. So your answer will always be for discounted payback period will always be longer than the simple payback period. It is because the discounted payback period takes into account the time value of money. So that's the reason when you take into account the time value of money, it will always result in a longer time needed to recover the initial investment. So that's on the discounted payback period versus the simple payback period. Okay, let's go to the last question. I think this is the last question, but let me just confirm. So NPV of a project is positive at discount rate of 8%. What can be inferred about the IRR? Okay, time's up. And I see some of you got this right. So IRR is greater than 8%. We'll take a look at why. Okay, here it is. So in the last question, the slide comes first and then the leaderboard. So at NPV is equal to 0, your discount rate will be equal to your IRR. We already talked about NPV IRR in the previous slide, so I'm not repeating that. When your NPV is greater than 0, your IRR will be greater than the discount rate. And when your NPV is less than 0, your IRR will be less than your discount rate. So this is what is on NPV versus IRR. So any guesses who's going to be in the top? So let me see if you can guess the right person in the chat. I'm really sorry. So while the quiz is on, I may not be able to cater to any troubleshooting questions. So you have to be there while we do the trial round. And that's the purpose of the trial round. So hopefully you understand. While the quiz is on, I cannot take any troubleshooting questions. So everybody is saying Sagar. What about second position? Who do you think will be on the second position? Okay, Vivek is saying Yogesh. Gaurav is saying Vishali. Okay, let's see what the final result is. Okay, so I think it will give the third position first. So Rishi is on third position. Congratulations, Rishi. Yogesh, so I think some if you got this right. So Yogesh and is on the second position, and Sagar has won this. Congratulations. And let's see, Bharat and Vishali are in the top 5. So congratulations to all the winners, and we'll get to the prizes soon. But I did not get any chance to update the slide, so the prizes will be what it was in the last session. So hopefully you already know what is the prize for today. So let me go back and share my screen. Okay, so prizes for the winners, you already know. Fourth and fifth get the foundations bundle. Second and the third get the launchpad bundle, which consists of the FP&A launchpad, which is a self-paced version of our flagship FP&A masterclass. And you also get a bunch of bonuses along with that. The first position or who is one, Sagar will get access to the live FP&A masterclass. So the next batch or the next cohort starts on 1st of September. So we will invite Sagar to the batch 14 of FP&A masterclass, which starts about 1 month from now. So thank you everybody for joining. I don't think I have anything else. Yeah, the discount for the FP&A Launchpad bundle, just in case if people want to buy it, they can get it. And the discount code is open Ninja17, and it usually it is open on Thursdays. So you can go and get that Launchpad at a very good discount, just in case if you find that I mean, if you find that to be of interest. Thank you with that, and we will see you in the next episode. So 8th of August, next Thursday will be the 6th episode, and probably we'll then take a break for 1 week. We'll not do any quiz on the 15th of August. We'll keep that as a break. It's a national holiday, so we'll probably avoid doing the quiz on that day, and we'll come back for episode 7 on the next Thursday, which is probably 22nd of August. So thank you so much for joining, and we'll take questions now. And let me just stop sharing my screen. Congratulations, yeah, congratulations to all the winners. Tanya is saying, can you explain how the discounted payback period is calculated? So let me pull that out and I'll show you probably one example. Okay, so I'm sharing my screen and let me know if you see this. Are you seeing the slide or are you seeing the Excel file?
You can see the Excel file, Asif.
Okay, perfect. So here is an example as requested. So this is a company which invests 48,000 in a new machinery, and the machinery is expected to generate cash flows, which is given into you in this table. And the discount rate is 15%, and you have to calculate the both the simple payback period and the discounted payback period. So how you usually do it is you first uh, document your or you tabulate your cash inflows and cash outflows. So in this case, cash outflow is on year zero, which is 48,000, and then you are making 20,000, or you're making 20,000, 18,000, 15,000, 12. So you're making different uh, cash inflows every year, which is the return on that machine investment. And to calculate the discounted payback period, you would use a present value factor, which is calculated by dividing 1 divided by the discount 1 plus the discount rate raised to the number of years. So in this case, it is raised to 1. I'm sure you must have done this while you were studying for your CA exams or any of your finance degrees. So when you do year 2, you discounted 1 divided by 1 plus the discount rate raised to 2. So that's how you calculate the present value factor. Once you have the present value factor, you calculate the present values of the cash flows. You do that by multiplying the uh, real cash flows or the dollar cash flows by the present value factor. And once you calculate the discounted present value of cash flows, you can do a cumulative calculation. So this is cumulative, meaning year 0 you are negative 48,000. Year 1 you recover 17,000 in net cash flows in terms of the present value. Although you recover 20,000, but the value of the that 20,000 today after 1 year is, I mean, you are getting that after 1 year. So the value of that 20,000 today would be 17,391. And you can then calculate this cumulatively, and you notice between year 4 and year 5 it turns from negative to positive. So your break even, I mean your discounted payback period will be somewhere between year 4 and year 5. And you can do more detailed calculations. So you can say 4 years, and so here is the calculation. So 4 years, and in the 5th year you wanted only $274 to break even, but you got $4,000. So that's 274 divided by 4972. So that's how you get the fraction. So it is 4 years and the fractional year. So it is expected discounted payback period would be 4.055 years in this case. Okay, so that was on the discounted payback period. Any more questions? We can take maybe 1 or 2 questions before we wrap up. I want to make sure that we end the session on time. So we want to make sure we stick to the 40 minutes or the 45 minutes. So we'll take maybe 2 more questions and then we will wrap up.
Asif Sagar here.
Yeah, go ahead, Thala.
So I'm actually interviewing at a company called Lloyd Davis. So it's a CPA firm in the US.
Mhm.
And they're offering me accounting advisory profile. So I just wanted to understand what exactly is accounting advisory and if FP&A comes into accounting advisory. So it's a small firm of 800 to 1,000 professionals.
Yeah, Sagar, probably we'll take this offline because you cannot judge based on the title. You'll have to see the job description in detail. So what you can do is you WhatsApp me the job description and we can take this offline. So without the job description, won't be able to comment on that, because title, anybody can put any fancy title and may not get you the right picture.
Sure, I'll send the link. Thank you.
Okay, all right. Any more questions before we wrap up today? And if not, we'll again see you in the next episode. The topic for next episode is working capital management. So hope you, do some research, some refresher on that before you come to the next episode. All right. I don't see any questions, any raised hands at this point. So we will let you go and enjoy your rest of the evening. And we'll see you in the next episode. Thanks, everybody. Thanks. Bye-bye.